let's start with rates, because it doesn't seem to make a lot of sense as we go into quantitative tightening, as central banks around the world get hawkish, that we're going to continue to see a 10-year trade at less than 150. What do you think?
Oh, I think that's absolutely right. I think, though, there is a chance that the 3 Fed hikes that are priced into the market is a little bit high. I think we're more likely to have 2, a pause, and maybe a third, rather than locking in a third. But even those 2 at 50 basis points probably takes the 10-year to 2%, maybe slightly above. And I think over 2%, markets start reassessing really where it could be going. And that's the stress point, I think, for a lot of risk. In the UK, 75 odd basis points we have been. We're up to 90 now. We've got, again, a rate hiking cycle kicking in. Probably 150 for the end of next year, I think, in terms of 10-year. But again, from an interest rate cycle perspective, it could also be in a 75 basis point context for the UK as well. So there's some room there to be wrong, Matt, but it's higher.
So, Luke, it's Kaylee in New York. In that kind of policy normalization environment, can you be an owner of government bonds? If you get your point on the curve right. Now, I think if we see a faster acceleration of interest rates, you could be going out to the long end for an inversion as the market prices in actually the policy mistake, they're going too hard too fast. If, however, this is just as I expect, it's probably the time to be short 10-year government bonds rather than owning government bonds outright, and maybe looking around the world for other places that you could be investing in terms of credit or equity, or even to some degree emerging market debt, where a lot of the countries have already pushed their interest rates higher. Yeah, well, let's talk about where some of those specific opportunities are, Luke, either in EM credit or in corporate credit.
Yeah, I think corporate credit still works. I'm a sterling fund manager. Put my hand up for that. I think that's an interesting market in the next year ahead. I think it's more interesting than Europe, where you could see the central bank tapering off some of its purchases and giving a headwind to markets and a lot of issuance in that space. Sterling doesn't have those kind of problems. It's still quite attractive. You're getting a reasonable yield for it and a reasonable spread. And I think the US investment grade market as well is just starting to be attractive. It needs to go a little bit higher, I think, in spread before we get too excited. And I think actually the better quality high yield companies, as people chase carry in this rising interest rate environment with high inflation, could still actually be interesting. So I've been on the program before and said this is no surprise, but we've got Carnival Cruises, which, as you said earlier on, is having a really tough time. I think that actually covers really strong. I'd be in airports as well. I think now is the time of worst sentiment for airports and probably the best time to get invested.
Yeah, I mean, that brings up the Omicron variant or the coronavirus. Maybe we get a new variant, right, Luke? Are you worried that these things get out of control? Because over the last week, people have been dropping out of work like flies, right? Even if they're not getting sicker than they were with Delta or the original coronavirus, they still have to quarantine. They still can't go out and buy stuff. They still can't get on a Carnival cruise.
Absolutely. And you know what? All the way through this pandemic, we've seen things speed up. We've seen the stimulus efforts speed up. We've seen the economic reaction speed up. The virus itself in its waves has sped up. So we've got to this 4th wave now. And if we're lucky, and if it works out, 6 weeks is about the time to peak, which would take us into January, early February for the UK, maybe a little bit later for Europe and the US, but we're within a month or 2 months of getting towards the peak of Omicron. And I really hope that Omicron, because of its mild generally impact, as far as we could see, is turning that pandemic into an endemic, which could be the end of COVID. So, yes, right now it's pretty awful. Right now, people are not getting to work, but we know this will change. You should have hope, Matt. I think it's a good time to be getting into these COVID-sensitive areas of the market.